This is Phil Gunn. I'm a Senior Sales Manager with Phillip Nova. In today's webinar, we will be discussing how did inflation and the Russia-Ukraine tensions impact the Forex market. Before we begin, I'd like to do a sound check. If you can hear me loud and clear, just type yes in the question box. Also during the webinar, if you have any questions, feel free to type them in the question box, and I'll address them during the Q&A session at the end of the webinar. Okay, great. Looks like everyone can hear me clearly. So let's begin today's webinar. Welcome once again, everyone, to the seminar, How did inflation and Russia-Ukraine tensions impact the Forex market? With the effects of inflation, we see Federal Reserve reversing the QE program and going hawkish on interest rates. This will no doubt have an impact on currencies, as we see the dollar strengthen against other currencies such as euro, pound, yen, sing, etc. We'll be discussing the biggest movement for Forex in the dollar-yen pair at the end of the webinar. We'll get into that really soon. My name is Phil Gunn, the speaker for this webinar, and I have been with Phillip Nova for more than 10 years now, since 2008. I hold a dual license in futures and stocks, and I'm also an account manager to help clients trading in futures and Forex, as well as shares, with understanding the product and market by providing coaching and economic information to make proper trading decisions. Investors are always looking for opportunities in the market, and I'm excited today to share on the MT5, which serves as a platform for Forex trading, as well as CFD products for retail clients. Throughout the webinar, you may have questions. Feel free to post them in the question box. My facilitator will arrange them and let me know at the end, and I'll answer them at the end at the appropriate time. This webinar will also be recorded and be put up for viewing at your leisure time. So just sit back and relax, get a drink, and enjoy the webinar. Before we start, just a disclaimer on the webinar today. Materials provided here is for general information and does not constitute a recommendation or solicitation to trade. Okay, for the agenda today, for the start of the agenda, we'll hop right into an update of the monetary policies of various main central banks, namely the Federal Reserve, BOE, Bank of England, and Australia, RBA. This is to give an updated look at the inflation numbers as well as interest rates. We will also look at the future outlook for it. We will then go on to discuss what is the impact on inflation outlook because of recent sanctions on Russia. Of course, before this, we had the COVID, which caused supply chain disruptions, which started to slow creeping up of inflation figures. In addition, recent China lockdowns bring back the whole episode of global supply chain disruptions again. But in this webinar, we'll be just talking about sanctions on Russia due to the European tensions, mainly because of the conflict in Ukraine. In the second part of the webinar, we'll go into showing the various products available for trading on MT5. MT5 is a multi-asset class trading platform where you can trade on Forex and CFDs. My aim today is to show you on how to traverse through the MT5 on the main functions, as well as the platform, since many have said that there's a learning curve to the platform itself. So it's actually quite straightforward if the functions are demonstrated to you instead of figuring out yourself. Since MT5 is a zero commission platform, you only need to track the swaps accumulated for overnight positions, and this can affect your overall profit and loss. I will also be sharing some pitfalls on the stop loss so that you can avoid unnecessary costs. In addition, we'll look at various order types and how you can match opposite direction trades on the same pair with one another using the close buy function. This will be shown on the MT5 app as well as the platform itself on the laptop at the very end. So near the end, we'll also be taking a look at dollar-yen chart, which is the pair that moved the most recently, and how the pair will play out in the near term. Okay, so that's the agenda for today. Let's hop right into the monetary policies for the central banks. First up, on the Federal Reserve from the US. US CPI data showed headline inflation surge further by 8.5% year-on-year in March. It is a new record pace in 40 years since December 1981. While core inflation also rose further to 6.5% year-on-year, a new high since August 1982. Headline inflation exceeded Bloomberg estimates, while core inflation was a little below Bloomberg expectations. The headline and core CPI inflation remained broad-based, with price pressures driven by well-known usual suspects of food, shelter, and gasoline prices, contributing the most to March 1.2% month-on-month CPI increase, of which half of the 1.2% was due to gasoline prices alone. Just in February, both goods inflation and services inflation remain elevated and on the rise. Some components of CPI like used cars and trucks and communication declined in March, but that does not constitute enough to move the inflation needle to the other direction. So inflation is expected to hit higher in second quarter before some easing in second half of the year. In a widely expected move last week, the Federal Reserve set its target federal funds rate to a range between 0.75% to 1%. On 4th of May, it was a unanimous decision, and Fed Chair Jerome Powell said policymakers were ready to approve half percentage point rate hikes at upcoming policies in June and July. The statement said that the Fed's balance sheet, which soared to about $9 trillion as the central bank tried to shelter the economy from the pandemic, would be allowed to decline by $47.5 billion per month starting from June, then July and August, and then by up to $95 billion per month starting in September. In other words, the printing of money will slow down starting from June and speed up in September. The Fed Chief Powell's speech was available online, and you can see that they are very transparent on their future rate forecast for the next two federal meetings. That is, there will be 50 basis points each time coming up, but depending on the data, the economic data at the point, a judgment will be made then. But most likely than not, they will stick to this 50 basis points, as market stability is what they aim to achieve. Well, notably, he mentioned that job creation has been robust, as there are more job creations than filling up of the jobs itself. And unemployment rate is relatively low at 3.6%. They expect the pace of job creation to slow down as unemployment rate to taper down slowly as the people slowly return to filling up the jobs in the market. Overall, the target for interest rate is dependent on two factors. One, inflation, which is high at the moment at 8.5%. And they aim to bring that down to an average of 2%, or at least that is their aim to do so. And secondly, it depends on unemployment rates. If they can keep unemployment rate low at the same time in the midst of interest rate increase. So it is actually a soft landing they are looking for, in their own words, that they wish to bring full employment back into the labor market and inflation rate down by increasing the interest rate to up to 2 to 3% interest rate by the end of the year, in best case scenario, where full employment is in the market and inflation is at 2%. Federal Reserve is aiming to achieve a rate for a neutral policy setting, meaning that they will have an interest rate that neither pushes economic activity higher or lower. So that's the stance for the Federal Reserve, and they have actually started this process of increasing interest rates. But strangely enough, two other central banks have done the same thing last week as well at the same time. And the next federal central bank is actually the Bank of England that has increased interest rates as well. But before that, let's look at inflation. Inflation figures surged to 7% year-on-year in March for England, the highest level in 30 years, led by higher fuel prices, energy bills, and furniture. Restaurants and hotel prices also rose steeply. Households are facing a huge squeeze on living standards as prices are rising faster than wages, in addition to high interest rates, increased tax rises, and an energy bill also rises. So The Bank of England actually started its first rate hike announced last Thursday. It started its first rate hike in December, but has since hiked a total of 90 basis points. The recent one being its meeting in May last Thursday, voted by a majority of 6-3 to increase the bank rate by 25 basis points to what is the interest rate now at 1%. This is the fourth consecutive policy meeting that the BOE has raised its key interest rate, making it the quickest pace of tightening since 1997, and taking its policy rate back to pre-pandemic levels. The bank said that the members in the minority group prefer to increase interest rate by 0.5% to 1.25% actually. So based on that, the BOE has raised inflation forecast to an April peak of 7.25% from 6% projected in its December report. UK inflation was already running at a 30-year high prior to Russia's invasion of Ukraine, which sent energy prices surging in UK and will exert upward pressure on the central bank's inflation projections. The bank said at the time that any further tightening of monetary policy would depend on the medium-term prospects for inflation, which were then propelled upward by Moscow's assault on Ukraine and subsequent threats to energy supply. Global inflationary pressures will strengthen considerably further over coming months, while growth in economies, the net energy importers, including the United Kingdom, is likely to slow down, the bank said in its Thursday report. The bank now expects inflation to increase further in the coming months to around 10% in the second quarter of 2022, and perhaps even higher later in the year. They also mentioned a possibility of a recession coming along in 2023. This no doubt spurred a sell-off of the sterling pound last week, and currently at the moment, the sterling pound is still looking very weak. So there's a room for a further 25 basis rate hike coming up due to the strength of the labour market in the UK, and also the upward revisions to the inflation outlook in UK as well. And that's for UK. Next, we'll look at Australia, the RBA. For Australia, the employment rate fell down to 4% in February, the lowest level since August of 2008. Employment rose by 77,400, led by full-time roles. The participation rate also moved higher to a new record high of 66.4%. In all, the latest job report underscores the strength of the labour market. A sizable improvement in labour participation is likely to exert upward pressure on the stubbornly sluggish wage inflation. Headline CPI growth came in at 2.1% quarter-on-quarter for first quarter 22, higher than the estimate of 1.7%, so there's an increment. And following the 1.3% quarter reading in the fourth quarter of last year, compared to the same period a year ago, CPI advanced 5.1% year-on-year this quarter, significantly higher at 3.5% in the previous quarter year-on-year, and also higher than the expectation on the last quarter for a reading of 4.6 year-on-year. So in other words, there's an increase in inflation figures as well for Australia. RBA raised its cash rate by 25% last Tuesday on the 3rd of May to 0.35% currently, defying the market expectations for actually just a 15 basis point hike, this was the first time borrowing costs for Australia have been lifted in an election campaign which they are undergoing now in almost 15 years. Furthermore, RBA signaled that further rate hikes is to come. This means that they were in lockstep with the Federal Reserve and other central banks in increasing their interest rates. Interbank cash rate futures are pricing in for another 25 basis point for June, and signal that RBA will raise it to 2.75% by year end. So the scheduled RBA meetings are always on the first Tuesdays of the month, every month, and the dates are shown as below. Okay, we have covered the monetary policies update for the three central banks that made their rate increase last week. We'll continue to look at the inflation that's caused by the Ukraine and Russia tensions. So first of all, Western countries have actually frozen the assets of Russian central bank to stop it using its 630 billion of foreign currency reserves. This caused the value of ruble to slump by 22%, which has pushed up the price of imported goods and led to a 14% rise in Russia's rate of inflation. The ruble has since recovered, but largely due to measures to prop up the currency. Buyers of Russian gas have to pay in rubles, and Moscow now requires Russian firms to convert most of its foreign profits into rubles. The United States has barred Russia from making debt payments using the $600 million it holds in the US banks, making it harder for Russia to repay its international loans. Credit ratings agency S&P now declare Russia to be in selective default. This means that the debtor has actually defaulted on a specific obligation, but not on the entire debt. After it attempted to make interest payments on rubles for $2 denominated bonds, the agency said that because investors were unlikely to be able to convert the rubles into dollars. Some Russian banks are also removed from the international financial messaging system SWIFT, which is used to transfer money across borders. This will delay payments to Russia for energy imports and exports. Other UK sanctions include major Russian banks excluded from the UK financial system, all Russian banks having their assets frozen, the Russian state and major companies cannot raise finance or borrow money in the UK, and a limit placed on deposits Russians can make at UK banks. The EU also said that it will target 70% of Russian banking market and key state-owned firms. On oil and gas, US is banning all Russian oil and gas imports, and the UK will phase out Russian oil imports by the end of 2022. The EU, which gets a quarter of its oil and 40% of its gas from Russia, says it will switch to alternative supplies and make Europe independent from Russian energy well before 2030. We also know that Germany has put a hold on the permission for use on the Nord Stream 2 gas pipeline from Russia to open it. So there's no doubt will cause oil prices to rise and inflation figures to rise globally. So, can the world survive without Russian oil and gas? Worries that Moscow may choke the gas flows into Europe, hurting the region's growth in the ongoing fallout from Russia's invasion of Ukraine. Russia have actually cut off supplies to Poland and Bulgaria, making good on threat to halt flows to countries that refuse to pay for the fuel in rubles. So the top side risk remains, despite the changing sentiment, in the bigger picture, as more European countries ban Russian crude, and these countries compete for crude supplies elsewhere. The French Finance Minister Le Maire said that he hopes to convince European Union partners to rein Russian oil imports in the coming weeks. And German Foreign Minister Baerbock said that Germany would end Russian oil imports by the end of the year. Well, this is not possible for some of the gas which depend. However, they have given leeway for some of the countries like Hungary, Czech Republic, to actually delay the stopping of oil imports from Russia, so that they, in the meantime, find alternative source for their oil supply. So JP Morgan Chase last week warned that if the European Union acts too quickly to ban Russian oil, this could displace more than 4 billion barrels of crude supplies per day, and it can send the price of oil, crude oil, to $185 a barrel. Another bullish driver for crude is the reduced chance of a near-term nuclear deal with Iran, which could keep Iranian crude supplies out of the global market. This will definitely further put on pressure on crude oil prices. So Iran wants the US to remove the Islamic Revolutionary Guard Corps from its list of terrorist organizations as part of Iran's nuclear deal with the Western powers, a move the US said it will not do. US energy firms last week also added more oil and natural gas rigs for a fifth row in a row, as high prices and prodding by the government prompts drillers to return to the well pad, according to Baker Hughes. So in other words, US active oil rigs have risen sharply from the 16.5-year low of 172 rigs since August 2020, signal an increase in the US crude oil production. The total oil and gas rig count now rises to 695 in the week of April 22nd. its highest since March of 2020. So how is the impact of oil prices on inflation? Well, Russia is the world's third biggest producer, so the world actually needs Russian oil. Russia is the biggest producer after the US and Saudi Arabia. Of about 5 million barrels of crude oil it exports each day, more than half goes to Europe before sanctions were announced. So you can see the dilemma here. Russian imports accounted for 8% of total UK oil demand and 3% of US demand, which is a slightly smaller figure. In early April, Russian oil production dropped by 700,000 barrels a day, according to the IEA in America. The IEA says that decline could reach to 1.5 million barrels a day by the end of April and about 3 million from May. What are the alternatives to Russian oil? Energy Produce research analyst Ben McWilliams said it should be easier to find alternative supplies for oil than for gas because while some comes from Russia, there's a lot of shipments from elsewhere. IEA members have released the equivalent of about 120 million barrels from oil stocks, the largest stock release in its history. US President Joe Biden ordered a major release of oil reserves from American Reserve in an effort to bring down the high fuel costs. The US also wants Saudi Arabia to increase its oil production and is looking at relaxing sanctions on Venezuela's oil. So you can see that a lot of action has been taken on the supply and demand side to stabilize the prices of oil. An increase in oil price will not only be seen at the gas station, but it will be felt virtually in all the goods and services that we use, because oil is a source of energy and is used in transportation of many things. Oil price increases are generally thought to increase inflation and reduce economic growth. In terms of inflation, oil price directly affect the prices of goods made with petroleum products. Oil price indirectly also affect costs such as transportation, manufacturing, and heating. The increase of all these costs can in turn affect the prices of a variety of goods and services, as producers may pass production costs on to consumers. This in turn causes inflation and the CPI economic numbers to increase dramatically. So we can see that in the near future, the increase of oil prices will have a major impact on inflation and the economy of the global. So that's actually the impact of inflation on the economy. And right now we'll go into the MT5 aspect of the webinar. Over here we'll be listing the products that's available for trading for MT5. First up we have FX, which is Forex trading, and we have all the major pairs and crosses, as well as spot gold and silver that's available for trading. This is a zero commission platform, and the only cost will be swaps for overnight trades, and this will be explained later on. Next, we have CFDs. CFDs on cryptocurrencies, mainly the main ones, Bitcoin, Ethereum, Litecoin, and Ripple. And you can trade in denominations of this Bitcoin in 0.1 denominations. We also have CFDs on the MT5 on commodities, mainly the energy sector, US and UK oil, which is Brent or light sweet crude, and then the cotton, orange juice, coffee seed, and sugar 11. For those who are familiar with the stock market, using the CFDs on indices is a good way to hedge against the downside of the market if a recession is coming. So we have all the major indices from the US, the Dow Jones, the Nasdaq, S&P 500, and UK, the FTSE 100, the Germany, the Eurodex, and Euro in the Euro stocks, Australia for the ASX 200. In the Asia, we have Hang Seng, Nikkei, Singapore FNCI, and China FTSE. So all the major indices are available through CFDs on the MT5 as well. Lastly, if you are interested in shares, we have also CFDs on shares, where you can long or go short on the shares, namely for the SGX, Hong Kong Exchange, and also the US Exchange in New York Stock Exchange and Nasdaq. So for the next part, We're going through the demonstration of the swaps, checking the swaps before trading for Forex. If you are doing intraday trades, no swaps will be imposed on the trade itself. However, if you carry the trade over 6 a.m. Singapore time, swaps will come in. And it's important to take note how much swaps you're receiving or paying before actually going the trade itself. But over here, we are showing you two kinds of platform. On the left is the laptop or the desktop version where you can check the swaps. On the right is on your mobile phone app. So on the watch list on the left, on the laptop, you can simply click and highlight the currency pair that you wish to check upon. For example, over here is the euro dollar. Right click on it and the window will pop up for the specification. Select specification and the next window will pop up to show you the swaps. For the MT5 app on your mobile phone, you can simply also select the pair from the watch list. For example, euro dollar here, and then select details. So having done that, you can see that the swap points and all the other information regarding contract specification should be shown here. The contract size by default is the regular size, which is the 100,000 contract size for Forex. You can, of course, trade smaller contract sizes, but this is just the default size. And this is actually representing as 1.00 unit on the platform. And the swap points are shown at the bottom here. As you can see, for 100,000 contract, you'll be actually paying, if you are long, means you are in the buy position in the euro dollar, of $5 USD every day. However, if you are short, you can actually receive 80 cents on the short side. So this is actually a demonstration on how you can view the swaps using this specification. And on the MT5 app, the similar thing will be shown, and the swaps will be shown as well. So all the information is readily available to you, even in the demo, but the demo will not show the actual swaps that's available. Only the live platform, once you open the account, will show you the exact swaps on the live trading platform. However, the buy and selling price will be exactly the same for the demo as well as the live trading platform. So it's important that you check on these swaps before you enter the trade so that you don't get a shock for long-term trading if you're holding the positions. So over here, once you have entered the position, this is on the desktop, you'll be able to see there's a column specified for the swaps. So this is actually for 1 day, and we are a long position in euro dollar for one regular lot size, 100,000 contract, and this is swap accumulated. So as the days proceed, more and more swaps will be accumulated and be shown over here in the column, on the swap column. So what are the important points to note for swaps for Forex? Right, swaps are accumulated on a daily basis. Once you hold a trade overnight past 6 a.m. Singapore time, swaps will start to accumulate. It's displayed in absolute monetary terms in US dollars. So what you see, $5 means $5 will be directly deducted from the overall P&L of the trade. Swaps are also calculated for weekend. So if you hold the trades from Friday over the weekend, it will be immediately calculated for 3 days of swaps. So intraday trades do not incur swaps. If you close out a trade within the day itself before 6 a.m. Singapore time, it will be swaps will not be deducted. So you can count the equivalent amounts in the smaller contract size. In the example, in 100K, you pay $5 for swaps. If it's a 10K contract size, you only pay 50 cents USD instead, because a 10K is 1/10 the size of 100K. So doing the math, these swaps will be 1/10 the amount that you pay as well. Swaps will change over time as central banks change their interest rates. For example, if Fed continues to increase interest rates, the cost of holding euro dollar will be buying long position in the euro dollar will be more hefty as interest rates for the Fed increases further. So do check on the swaps daily to make sure that the amount that you're paying is not a shocker to you. So these are the pointers for swaps on Forex. Now we look at how you calculate swaps for CFDs on indices. So indices, CFD indices such as the Nasdaq example shown here, it can be calculated by this formula using contract size times the tick size times the swap value. To retrieve this screen has been explained earlier by going through the watch list and selecting the Nasdaq index and then selecting details or specification on your laptop. And you'll be able to see a similar screen where the contract size is shown and the tick size is shown as 0.1, and as well as a swap long and swap short. So in this case, a swap long for a day for the one contract size of NASDAQ index is actually $39.37. Right, but this is the formula: contract size times tick size times swap value. So 1 times the tick size given by here 0.1 times 39.37 gives you a daily swap of $3.94. In other words, you pay $3.94 if you're long on the NASDAQ index for 1 day, right? So there's also a cost for shorting if you're short on the NASDAQ index, and you can calculate accordingly also, roughly about $3.28 or so. So on the actual screen itself, if you're in position, you can tap on the NASDAQ position, right, over here, and then holding on to it, it will expand the screen over here, and you'll be able to see what is the swap accumulated. And so this is also for a day swap, and the swap accumulated was $3.94 as calculated. So this will accumulate over every single day, and this will be displayed to you on your MT5 app also. Right, that is for indices. For commodities, the similar formula applies. So in this example, we use for commodities the US crude oil, the light sweet crude oil. So it's also contract size and tick size and swap value. The contract size is 100 barrels of oil, and the tick size is 0.001 as shown here. And then you multiply it by the swaps incurred. So doing a similar calculation, you can derive the value that for swaps daily for the long position in the one contract size of this US oil, it will cost $3.60 on the CFDs for this contract. Right. So what are the notes to take note on swaps for CFD indices? Very similar to Forex, they are cumulative on a daily basis. They are displayed in absolute USD terms as well, and swaps are calculated for weekend also. Intraday trades do not include swaps, but only overnight trades, right? So one other thing to take note is that there's actually dividend adjustments on CFD shares, right? So if you're long the shares, when there's dividends, it will be paid out to you also. If you're short, you have to pay for the dividends. Swaps also may change over time, and you have to take note of the changes by checking it every time. All right. One important thing that many people don't know about commodities CFDs on MT5 is actually the basis adjustments. This applies to commodities such as cotton, orange juice, coffee seeds, sugar 11, and especially the oil sector, which is the UK oil or US oil. The basis refers to the difference between the price of a spot asset and its underlying futures. Price basis adjustment occurs when the opening price of spot CFD contract is adjusted according to the price fluctuation on calendar spreads of its underlying futures. This is to allow a smoother price continuation as the spot CFD price takes reference from its underlying futures contracts, as futures have fixed expiry dates. So there's an adjustment of price of the entry of price of your CFD contract on commodity contracts that will be debited or credited to the account depending on the net positions held overnight. The purpose, as mentioned, is to negate the impact on the trading profit and loss that arise due to the price adjustment of the CFD contract. So if it is positive adjustment, long positions will be debited along the corresponding value, as the inflation of the price should not be considered on the actual trading profit. Conversely, short positions will be credited. So please take note that this adjustment takes place every day, and this is an additional cost if you take a look at it. So it's important that you are aware that basis adjustments are actually a thing for commodity products, as mentioned over here. Looking at a quick example of what the adjustment will look like, this is an example of the energy sector, the UK oil. The price adjustment is 0.01 per barrel in this example. In other words, it was adjusted 1 cent higher the next day at the open. So let's say if you buy one contract size, and one contract size is 100 barrels of UK oil, and you hold it overnight, the price adjustment is 1 cent US dollars times 100 barrels. That gives you a $1 US that you need to pay to negate any trading profit to the price at basis adjustment. And take note that this adjustment happen every single day. So let's say you sell the 100 barrels of UK oil that's held overnight. In return, you actually receive $1 US for the readjustment of the price to its underlying futures price. So you receive US $1 if you short the UK oil. So do take note of this price adjustment for commodity contracts. This, however, does not apply to any of other CFDs on indices or on Forex or spot. It's only on CFDs on commodities. So this is the additional cost that you need to take note of for basis adjustment. Next, we'll move quickly into the placement of orders on MT5 app, as many men have mentioned that they are not very familiar with it. So from the MT5 app, you can see the quick access menu at the bottom. There's a few options over here. This is the watch list on the quotes, the chart. This is the trade button where you show your positions, and the historic button, all the trades done. So by clicking on quick access menu quotes, you come to the watch list, and to select the quotes, you can actually search for it by entering the search field over here, or can click on the edit button over here and add the pairs that you wish to trade in. And then after that, you tap on the pair itself and then select trade button, and that will go into the trading screen. So you can see that once you tap on the currency pair, the menu comes up and you can select the trade button over here, right? Upon selecting the trade button, this is the trade menu, right? There's on the top is the exchange execution. This selects the order type, which is the market order. You can change to pending order if you want to queue for the price, but by default it will be market order, which is exchange execution. So the unit here is 1.00 is the regular size, which is 100,000 contract size. You can change it by just simply input the figures over here. The smaller size you can trade is 0.01 unit, which is only 1,000 in contract size of Forex. And this is the market rate that's shown. Simply by tapping on buy or sell will actually execute the trade immediately. So from order type selection, market order, to volume, which is the contract size exposure. And then you can leave the stop loss and take profit taking later to enter later, and click on execution by buy or sell. So once you've done that, this is the second order type, which is the pending limit, which you want to queue for the price. We mentioned just now the market order, which is exchange execution. You can select buy limit and sell limit, which are the common order types that we use for entry of positions and exit of positions. We typically do not use any of these order types for entry of positions. If you want to put a stop loss, I will show you on how to do it on the next screen. So just select buy a limit or sell limit if you want to queue for a price, and enter the price that you want to queue at. So the protected order, the take profit, and the stop loss can be done later. So similarly, once you click on that, the buy limit, you can input the contract size. In this case, it's a 0.1 unit or 10,000 contract size in the Aussie dollar. So you can key in the price that you want to queue for, let's say at a lower market price of 0.7410, as an example, and then you place order. And it will proceed to submit the order for you. Once you have done the order, this is example shown on the trade button on the MT5 app. You will see a position here, right? So you are in position to buy. You have already bought 0.1 unit, which is 10,000 contract size in the Aussie dollar. So by tapping on the position you wish to place the stop loss order or the take profit order, you can do so. By tapping on it, select modify position to input these values. Right on the screen over here, you'll be able to see to stop loss or take profit levels. Just key in the levels that you wish to take profit or stop loss, and this will be tagged in particular to this position that you have, right? So once you have done that, you can see that the values entered will be shown here on this exact position which you entered at 7427, and the stop loss is shown and the target profit is shown. So when the market moves in either direction, they will close out the trades accordingly. So you can actually have the order placed for you, and you can switch off the app or go to sleep, and the orders will be executed accordingly even when you are not looking at the phone. Okay, next, to close the position at market, you can do so by tapping on position to close, right? And then select close position. So in this case, it's a euro dollar contract. We tap on this position that we want to close immediately. We select close position, and then you will see that this screen will pop up with an orange button to close at market. This shows that the close this ID number, which is the ID number of this position that you have, right? 3833987 is the exact position, with a profit of $10.30, right, at market. Right? Do not click on sell over here, because doing so will actually initiate another new position, which is a opposite direction position into your position that you have now. To close this particular position, you need to select this orange button of close position to close it off, right? However, if you make a mistake, not to worry, I will show you on how to match off two opposite positions later. But to close out the position, simply click on the orange button and the position will be closed. Right, so how do you close if you make a mistake and open two positions of opposite direction, like in this case? So in the example here, we have a euro dollar buy position, and we also have a euro dollar sell position. These are contradicting positions, but in the same currency pair. So we can match up these two positions together if you want to do so, right? So select close by upon selecting one of the positions. Next, choose the position that you wish to match to. So the opposite direction is the sell position, close by the position of this sell position. If there are more than one sell positions, all the positions, sell position will be displayed over here. But in this case, there's only one sell position available, hence only one option for you to choose. Select this and then close these two IDs with one another, which is the ID number of this buy position and this sell position, and they will match the order with one another to close out. So that's how you actually match positions if you have two opposite direction positions, right? So things to take note on the stop loss orders. It's good that you place the stop loss order before you go to sleep, but I would actually recommend you not to do that for overnight trades. This is because of the trading hours for Forex is very depending on the liquidity of the banks. So as the banks are the market makers and they are closed during the weekends, and they're open from Monday 6 a.m. to Saturday 6 a.m. Singapore time. Stop loss orders not filled during the weekends can only be done when market opens on Monday. So if there's a price gap, right, you will be closed at a very awful price, right? So low liquidity hours in the early morning hours of 4 o'clock Singapore time to 9 o'clock Singapore time is the time where you need to avoid placing any form of stop loss, which is my advice. It's good that within the day itself you can place stop loss and profit taking, but for overnight positions during these hours, the spread between the bid offer price will actually widen as there are no banks actually really open at the time as all the banks are closed. Hence, they will actually put a very wide spread. And if you place a stop loss price, your price will be swapped up by the banks, and that will result in a loss, which is not desirable, as the market will spring back up when the market liquidity returns to normal after the Japan banks start to open again. So hence, that is the reason why we do not suggest that you place stop loss orders, which is not advisable during this hour from 4 to 9 a.m. Singapore time. But it's still advisable to instill your stop loss for intraday trades any hours of the day. So this is just for you to take note if you are trading live on our account. Right, we are covered on the demonstration on MT5 app. We will look at one of the pairs here for the dollar yen, right? Before that, the BOJ first, and the outlook for this pair. So the Bank of Japan, as widely expected, keep its monetary policies unchanged at its NPM monetary policy meeting. It continues a different strategy from all the other countries, G7 countries, which are on the cusp already starting to normalize the monetary policy. As Japanese central bank kept the preference from low interest rate and easing bias, and expects short-term and long-term policy interest rates to remain at their present level or even lower. Right, so they will continue with this monetary easing as all the other countries have already started to change their policy stance. So the inflation forecast for Japan has risen to 1.9%. Before easing back to 1.1%, they expect in the next year. And they due this to the impact of the significant rise in energy prices, the oil prices, and they expect it to wane subsequently and recover. So the inflation to them will actually recover after that. Further, their GDP forecast for the year 2021 is slowed down to 2.1%, which is expected to be 2.8% previously, 2.8% previously to 2.1% expectation now in January 2022. So most notably, its main takeaway is that it will defend its 0.25% 10-year Japanese government bond yield cap for the long-term interest rate strategy. So as widely expected, it resolutely keeps this policy measures unchanged to achieve the inflation of 2% objective. Although this is not unanimous, this was an 8-to-1 vote. Even as the Japanese inflation is heading higher, the driving factor is largely stemming from an uncertain supply shock, while domestic demand remains weak, in line with Kuroda's inflation view, as is skeptical that the imported inflation that is surging in many parts of the world will lead to sustained price gains in Japan. And it will take some time for sustainable inflation. A clear indication that BOJ is not considering the policy normalization or rate hikes anytime soon at all. Their next meeting for the BOJ will be on the 16th, 17th of June, and they'll have a post-session press conference, but there will not be an updated outlook report. So the bank will not have an updated outlook for their inflation figures. So this is why we are actually looking at the dollar yen chart, and you must be aware of the rising of this chart. And to be honest, because of the basic fundamentals that of BOJ's response, the dollar-yen pair has risen to levels not seen since 2002. Indicated in the dark purple are the weekly resistance lines. I've shown two regions over here. They are the regions of the two lines, 132.97 to 134.9, right? And it's likely that these levels will be tested in the future as Fed continues to say that it will raise interest rates throughout the year, specifically in June and July, each time 50 basis points. The area of resistance in light purple are from 1998. I put them out from so long ago. And the region for 144.25 to 146.32 as well. It was put from way in 1998. The scenario of uptrend is showing no signs of correction at all. And this uptrend will continue as long as BOJ maintains its stance. However, in a hypothetical situation that it decides to correct, the best case scenario levels for this correction is thought to be a 61.8% retracement. That's the best case scenario. That will bring us down to the level of 121.8. 121.8 is the 61.8% level. So, however, a more possible level will be 127.5 or 125.07, which is a 23 or 38.2% retracement. But these are just generic hypothetical levels that set, which are not at any point in time possible right now, looking at the basis impetus because of Fed Reserve and the BOJ. So people who are thinking to short dollar might wait and hold off before and for the Bank of Japan to say something before you start to decide to short this, because swaps are pretty hefty if you are actually shorting on the dollar yen as the dollar has increased its interest rates. Right. So we'll do a quick demonstration on the platform itself because we promised to show you how to place the trades also. So just a quick one, I'll just click on one of the pairs. When you place the double click on the currency pair, this trade menu will come up, and this is the Aussie dollar pair. And similar to the MT5 app which was shown just now, you have the exchange order execution, which is the market order, as well as the pending order. And the contract size you can choose accordingly. And you can queue the price for it which you want to, and execute it. So let's just do a quick market order. Let's say, for example, if we buy this over here, so you can see it's displayed over here as you enter the position for one regular contract size at this price, market price 59. And because of spread, there's a small negative here for a small loss. But once it turns positive, you can actually close out the trade, and there will be no commission, right? There's no swaps for intraday trade, so as you can see, it's currently 0, right? So that's just a quick one on how to use this to display to place an order on the desktop, right? So if you want to close this immediately, just simply double click on this position. This is close a market order. Or if you want to instill a stop loss or take a profit, you can also key in the values over here, the price you want to stop loss and take profit in, right? So any point of time you just want to close, you can click on the yellow button and close out the position. So that's just a quick example on how to place a trade on the desktop. So I'll move on to the closure. Okay, so we have almost come to the end of the webinar. Let me just touch on the available service offered by Phillip Capital. If you sign up for the account which is available online using my QR code, which will be shown later, I'll be providing WhatsApp economic data updates every week. There will also be daily technical discussions on trade levels. This is sent daily on the market trade levels, and I'll be assisting you with any questions pertaining to your account or trading. I cover markets on Forex, global indices, and precious metals, energy, and commodities. You'll still be executing trades yourself, but you have a second perspective on the trade levels and trade ideas, as well as your account matters. So I'll be actually your servicing AE if you want to sign up. And for people who sign up, we can actually also do a technical analysis, meetup, course, coaching at our office. So these are the services I provide. And for stocks, once you open the account, you have the daily one stock suggestion before the US market via WhatsApp. So if you wish to receive that, it will be circulated to you via WhatsApp also. To open the account is to trade FX and CFD is very easy on MT5. A opening account is free. You can actually open it first without any fees. And there's also a mobile app which I will demonstrate to you to place on your phone. If you're interested to get started, you can open a live trading account with Phillip MT5 and no cost. Currently, there's a promotion. So for opening account, there's no minimum deposit required. But if you wish to go for the promotion, you have to deposit $1,000 SING, and you have a 50 SING credited to your account. Go into details on the next slide. This is the screen QR code for the promotion. If you wish to open another account, you can scan this QR code. There's no admin fee or any cost in maintaining an account. So once the account is open, you can have the account as long as you want and only inject funds if you want to trade. So the process is very easy via your SingPass and can be done within minutes. Simply just create an ID, new user by scanning a QR code below, and the link will be tagged to me, and I'll be assisting you in opening an account using the QR code shown here. You can also use the link as shown beside this QR code. So this is the promotion over here that you can use for 72 hours from today. So for 3 days, this promotion will go on. You have to open the account via this QR code within these 3 days and fund a minimum of 1,000 SING. Once you've done that, you will have 50 SING credited into account, which will be converted to US dollars because MT5 is a USD based account. And so all the attendees, only attendees in this webinar can scan this QR code within 72 hours, and it will expire after Friday, the 13th May. Oh, it's the 13th May, Friday, okay, 2022 at 8 o'clock, right? So any submission after that will not be eligible for this $50 credit into the account. So the SGD 1,000 had to be credited from 1 week of account activation. So you have to fund the account by 16th of May. So take note that the credit cannot be withdrawn for three months after, but after that you can actually withdraw them. But take this opportunity to start the account opening first, since there's a promotion for opening account and it's free. And I'll give about 10 seconds for you to scan this code if you want to open a live account. Okay, meanwhile, if there's any questions, you can start to post them. Yep. So I have some questions over here. What are the contracts available in MT5? The contracts available are the Forex contracts and CFD contracts. So I did have a slide earlier on to show you what are the possible underlying for CFDs. CFDs on indices, on cryptocurrencies, on the energy sector commodities, as well as stocks and shares. On the Forex, we have all the major pairs and crosses, as well as the spot gold and silver. Is there a platform fee for MT5? There is no platform fee at all. Opening account is free, so you can maintain the account as long as you want until you're ready. You can inject the funds. There's no commission rate for the trading, so you can actually the entry price that you place and exit price, the difference will be the P&L that you be credited into the account. However, there's swaps that's incurred, which you can actually refer to, and I've explained earlier on how to check out the swaps. You can refer back to this webinar, which we posted to you later on if you want to revise on how to check on swaps. How do I sign up for coaching services? Is the coaching services free? Yes, it is actually free. If you're interested, we can arrange to meet at our office for the one-on-one coaching service. Simply just indicate in the response and then or email us. I'll show you my email later, and you can actually let us know if you're interested in the coaching service. Do you offer a demo account? Is it free? Yes, there's a demo account available, and you can scan them over here using this link over here on the left for free demo account to try out first. For those who want to message me, you can actually, for the coaching or anything, you can, these are my contact details, right? So that's about it. That's all the time we have for today. So feel free to drop me the message or email me if you have queries. So thank you so much for being a wonderful audience for tonight's webinar. The link to the recording of this webinar will be made available on our follow-up email tomorrow. If you have any query about the webinar or would like to get started, simply reply to the email. We'll get in touch with you. So this is Phil. I'm signing off. I wish you a good evening ahead. And I'll leave the slide at the web demo account and a few minutes on the opening of live account. Thank you, everyone. Have a good evening ahead.